Hi, and welcome to Chapter 7, Dealing with Foreign Exchange. It's a very exciting chapter, lots of stuff going on. For any of you who have traveled overseas, you know what it's like to trade currency. You understand what the costs are. Where should you make the exchange? How much they're charging you for the exchange? Should you convert the money before you leave? Should you convert when you're there? And who's going to give you the best rates? Should you buy in advance? Should you wait until you go there? Is that going to fluctuate? All of these questions that you would have for yourself as a tourist apply to business on a larger scale. So let's go over the learning outcomes for this chapter. We'll look at the factors that determine foreign exchange rates. There are going to be several. Articulate and explain the steps in the evolution of the international monetary system. Identify strategic responses firms can take to deal with foreign exchange movements. And the three things you need to know about currency when doing business internationally. Let's just start with the opening case, the ethical dilemma. So again, please follow along with your book. This is on page 103, and it's the opening case, the almighty dollar. Great way to start the lecture. And so what we have here is just a really interesting way of understanding what it means to have a strong currency. So the first thing that you need to know is that the United States contributes 23% of the global gross domestic product, about 12% of merchandise trade, and 35% of market capitalization, but 60% of the world's foreign exchange holdings are in dollar. And I'll just show you some updates on that, by the way. But that's just astounding when you think about, the U.S. dollar being responsible for 60% of foreign exchange holdings. What does that say about the currency? It's strong, it's reliable, and people prefer to hold American dollars than even their own currency or even another currency, so that in bad times the money still has value. They're not taking a chance on some perhaps devalued currency. Less than 10% of China's trade with the world uses the yuan, right? The renminbi yuan. So we'll talk also a lot about that. The U.S. pursues a cheap/weak dollar policy, and that's just pretty much historic, going back to the Plaza Accord. It was already kind of happening before, but the Plaza Accord really solidified that. The Plaza Accord, named after the hotel where it was ratified, is an agreement between the original G5, France, Germany, US, UK, Japan, to manipulate exchange rate by depreciating the dollar. The problem with that is the unintended consequence led to increase of yen and Deutschmark. So, Germany used to have the Deutschmark before the European Union created the EU through Schengen. And of course Japan had the yen. So this caused Japan to increase trade and investment in East Asia and rely less on the US. To kind of ratify that, to resolve these problems, later in 87, a few years later, came the Louvre Accord, named because it was ratified in Paris. This was aimed to stabilize international currency markets and stop continued depreciation of US dollar caused by the Plaza Accord. Still, the weak dollar policy has been kind of there ever since. Now let's go into what determines the foreign exchange rate. The foreign exchange rate is the price of one currency in terms of another. That's it. Again, for those of you who've traveled overseas, maybe you've gone, to Mexico, and when you convert from dollar to pesos, you're really stretching that dollar and you're getting a lot of pesos from just the $1. And depending where you are in Mexico, obviously in Mexico City, things are going to cost more. Cuernavaca maybe costs more, but other less touristy areas in Mexico, you'll see that your dollar is going to get you more with those pesos. Appreciation is the increase in currency value. And so again, these definitions do not exist in a vacuum, right? When you think about appreciation or depreciation of a currency, it's in relations to another currency. So appreciation of the dollar, for example, would mean that the dollar is getting stronger in relations to other currency. And we'll talk more in a little bit about whether that's good, bad, or neutral. Depreciation is the loss in currency value. So now your currency is losing value. So, for example, that's what you would see here in that little graph. That's a depreciation, graph. And again, depending how you're measuring it, it could mean a lot. So to just kind of dive right in, I wanted to give you an example of what that translates at on a very, very basic, very superficial, basic level. And so let's come up with a British family with the most common last name in England is Davis, right? So we'll call them the Davis family, and they want to invest in real estate. This family lucked out, and they came across £500,000. So Great Britain pound, right? The British currency. So they have, let's say, £500,000, and they've decided as a family they want to invest in real estate. They live in London, so they're thinking, well, we could buy a flat in London, a teeny, tiny, tiny little flat. And that's right now, this is an example that I found here, £500,000 in London. That's what they could do, buy a 2-bedroom flat in London. Of course, they could go to the country, but maybe they want to rent it out. Who knows? Maybe they're thinking about, a vacation home down the line. Anyway, that's option one, right? Option one. What would be option two of infinite options? Well, let's say that maybe, it rains a lot in London and they decide, why don't we maybe look elsewhere? And so they decide, we like Spain. There's a beautiful city in Spain called San Sebastián on the north side in the Basque country. And so they think, well, what if we went to Spain? Well, right now, as of today, they can get a 4-bedroom house in San Sebastián for about 550,000 euros. So you're wondering, where did the 550 come from? Well, the current conversion, again, this is as of today, there we go, 10/4/2020, 500,000 pounds gets you 551,000 euros. Let's say 552,000 euros. So what does that mean? Well, you can stretch that pound, right? You're stretching that pound against the euro because the pound is stronger than the euro, right? The euro is slightly weaker than the pound. In fact, you could see it right there. 1 pound gets you more than a euro. 1 pound gets you 10 euros. So that's how you're getting an extra 50K. Plus, of course, we're not considering London is one of the most expensive places in all of Europe. That, of course, San Sebastián is going to be cheaper, but you're getting more for your bank anyway. So that's option two. And maybe you're thinking, since we're going to go tropical, let's see what's going on in Hawaii. So now what happens is this. That 500 pounds today gets you $646,000, right? Why? Because 1 pound gets you $1.3. So again, you're stretching that pound more with the dollar than you are even with the euro. And as of today, there's a nice condo there in Hawaii for $650,000, 2-bed, 2-bath, right there, Waikiki. So again, just some ideas. Now, in that vein, I want you to just kind of look again at the fact that you're converting 500,000 pounds into $646,000. That sounds like a great deal. Well, let's look back in history a little bit and let's see what the conversions have been for the pound to the dollar. And what you'll see here is a historical exchange rate chart of pound to dollar. And look right around here, right? This is around 2007. And what do we have? See that 2 right there? Right around here, literally, British investors double their investment in the US. That 500,000 pounds in 2007, that 500,000 pounds got you $1 million property is what happened there. And so, in fact, during the big financial crisis, you could see how things happened there. But that's exactly what happened. Right around there, a lot of real estate people in Manhattan during the last big recession that we had, not the COVID recession we're having now, but the last one. A lot of real estate people in Manhattan didn't even bother trying to advertise to American investors. They contracted out with websites and investors in the UK because they realized they were better off trying to court British investors who could double their investment, basically. All right, so that's for that. Moving along, I hope you find this interesting. It's fascinating. I'm trying to apply it. Again, I'm oversimplifying it, of course. There's all kinds of consequences for foreign investors. You have to look at the tax consequence, etc., etc. Supply and demand of foreign exchange. So there's basic economic theory over here, which is the commodity's price is fundamentally determined by its supply and demand. Basic. Strong demand will lead to price hikes. Oversupply will result to price drops. Now, about 60% of the world's foreign exchange holdings are in US dollars, followed by 26% in euros, 4% in pounds, 3% in yen, and 1% in yuan. So yuan, that should be, yuan right there. The renminbi, the Chinese currency. So having said that, a couple of things. Number one, the dollar was actually lately dropping against the euro for a while, up until COVID-19. So even though euro is getting 26% in the world's foreign exchange, it was gaining until the pandemic. And because of the pandemic, I'll show you in just a little bit, people have gone back to the dollars, right? In terms of the renminbi, there's a really interesting story going on there that I'll share with you here in just a second. China has over $3 trillion in reserve. It's just fascinating. So let me share the screen here with you. This is from the International Monetary Fund. And this is showing you the international reserve and foreign currency liquidity for the mainland China, right? And what do we have here? We have $3.3 trillion official reserve assets, and all of that is most of that, I should say, is foreign currency reserve, of course, in dollars at $3.1 trillion. And so that's what's happening here in terms of how much cash, how much money China has in terms of just dollars, right? So China is sitting on $3 trillion in currency reserve, and so this is from Forbes. And again, you'll see a lot of resources there, information with variations into in terms of what that means for China and what that means for the U.S. Some people believe that's a risk for the U.S. because that gives China too much power. But most economists seem to think it's a good thing. All right, so that's for that. Moving along, we're going to now look at what determines foreign exchange rate. And so several things, right, affect supply and demand of foreign exchange rate, and we'll look at each of them as we move forward. There's a relative price difference and PPP. So I think we've touched on PPP before, purchasing power parity, but we're definitely going to do a little bit more now. It's fascinating for those of you who remember your econ class, basket of good exchange, Adam Smith, all that stuff. Interest rates and money supply is going to, of course, have an effect. And governments deal with that very differently. Productivity and balance of payments is going to be another one. Exchange rate policy, and of course, very importantly, investor psychology. All right, so let's go with the first one, the relative price difference, or as we call it, the law of one price, right? So we have the purchasing power parity or the law of one price. So I have a basket of goods over here at the top right. This is a 2020 basket of goods. You got an Amazon gift card, there's some candy, some soda, etc. And so the idea would be, what if, how much would that basket of goods cost in different countries by converting currencies, right? The Economist magazine came up with a really fun little instrument called the Big Mac Index. The idea was that out of the 200 countries on the planet, the great majority of these countries have have McDonald's, right? Very few countries do not. In fact, there's some views out there about the idea that a country has been developed or has been part of a greater investment spectrum when McDonald's decides to have a presence there. All right, so the law of one price. So what you have here is it's determining the equivalent amount of goods and services different currencies can purchase. Again, Adam Smith referred to this as the basket of goods. It captures the difference in cost of living between countries and argues that exchange rates should move toward levels that would equalize the price of an identical basket of goods in any two countries in the long run. And so let's kind of dive into that a little bit, right? So I want you to consider currency, right? So already we have a little bit, this is an older chart, so it might not be accurate anymore, but Norway, when you look at the zero over here, that's the American dollar, that's the benchmark, right? So, what they've done here is they've said, okay, the US is at zero, and when this, I'm so sorry, I can't make out the year on this one, but when this particular graph came out, the US was selling a Big Mac for what, $3.5, right? But Norway was about $7 when you convert that to dollars, right? And in this case, it's overvalued by almost 100% there. The cheapest place to get a Big Mac at the time was China, right? So again, these are undervalued, these are overvalued. Depending on the year, sometimes you'll have 2, 3, 4 countries overvalued, and sometimes you'll have more. All right, now let's kind of let's look at that in perspective, right? And the perspective here is the value of the currency as applied to purchasing power parity. So the first question is this: is a strong dollar good or bad? Right? Which are the two? So these are covers from the Economist magazine at different times. Falling dollar, what that meant. Mighty dollar, what that meant. So first, just go back to the example that I gave you about a strong pound in England and what that meant for British investors, right? Basically for them, it means they can buy stuff overseas for super duper cheap because they can really stretch that pound. Congratulations, right? So they can go and travel to the US and go to Disneyland and spend a lot of money because all of a sudden when they convert the pound to the dollar, they can stretch that dollar. But let me ask you this: what does it mean for you when you leave the US and you're debating where you go on vacation and you're thinking about going to London? Again, very expensive place. What it means for you is that you're really going to, in your case, your dollar is going to shrink. It's not going to go very far. Things are going to cost a lot. Now take that approach to import and export. It's going to be more expensive for us having a weaker currency than England. It's going to be more expensive for us to import product from England. You in fact want to try to import from countries that have a weaker currency. Case in point, of course, China. And so a strong dollar is great for you when you want to have purchasing power to import from other countries, but it's going to really cripple you in terms of exporting. I hope that's clear, right? And so it's counterintuitive. I just want you to kind of think about that the strong dollar is horrible for exports. The weak dollar is great for export. So if you're trying to focus on manufacturing and you want to export, you're going to want a weak currency. As soon as your currency starts to get stronger, then your export's going to go down, right? All right, let's go to the Economist magazine, right? So again, as I stated before, the Economist magazine came up with the Big Mac index. So that hyperlink, let me bring it in. Here's the hyperlink for the Big Mac index. And so what do we have? This is really cool. This is the interactive Big Mac index, right? And when you want to look at today, okay, so Switzerland has the Swiss franc. We'll talk more about that later on when we talk about economic integration. But famously, Switzerland wanted to keep its neutrality and independence and sovereignty, and decided to just opt out of the whole European Union thing. And so Switzerland has, in fact, the most overvalued, the strongest currency out there, with the Swiss franc. Again, great for Switzerland when they want to import stuff into Switzerland or use that strong Swiss franc to buy outside of Switzerland. But this is going to hurt sales of product that they want to export that are made in Switzerland. By the way, if you're thinking Rolex, etc., obviously those are items that don't tend to always, the clientele doesn't seem to care if costs go up or not, maybe. Lebanon is the surprise over here, right, in Sweden. So the krona, Sweden has always been a little bit, always up there, right? Norway, interestingly, now is undervalued for the first time in a long time. The krona, not to the krone, compared to the krona, not to be confused. And of course, Denmark has the krona, but they're different. Israel is looking like it's moving up the list in terms of currency with the shekel. Anyway, giving you some ideas as to, again, there's the US and the pound. So it's interesting because even though we just talked about the pound being stronger, when you factor everything in terms of the cost of living, etc., the raw index, I'm sorry, let's look at the GDP adjusted index. Sorry about that, I should have done that first. GDP adjusted index, there you go. Thai baht is super, overinflated. And then, there we go. There's a shekel, the Swiss franc still there. There's Sweden again. You get the idea. And the Eurozone is close there with to the dollar. But again, you get the idea. So where do you want to go on vacation? Well, Russia, Hong Kong, South Africa. These are the places where you're going to really, really, really going to be able to stretch that dollar. All right. Let's move on. So now that we've done this, let's look at interest rates and money supply. So what we have here, short run direction of exchange rate movement. We have high interest rates attract foreign funds and enhance exchange values, and exchange rates influenced by the rate of inflation of the country, money supply. I'm sure you remember all that stuff from your econ class M1, M2. To avoid losses from holding assets in depreciating currencies, investors sell them for assets denominated in other currencies. This is what, I have a little thing here from The Guardian. Brexit panic wipes $2 trillion off world market. That's very much what happened in the UK, with a lot of investors freaking out about the UK leaving the European Union, thinking, I don't know if I want to do this. And so there's been a lot of loss there. Massive sell-off of assets in UK post-Brexit referendum. Moving along. Now, productivity and balance of payment. Let's see what we got. An increase in by the way, for those of just remember, we're still on page 105, and we're looking at the second item for what determines foreign exchange rate, right? So here we are, item number 2, productivity and BOP. So increase in productivity improves a country's competitive position in international trade. An increase in the value of home currency as well is the outcome of an increase in productivity. So for example, most of the China-bound foreign direct investment inflow in dollar, euro, and pound have to be converted to the yuan, thus boosting its demand in value. So this changes the balance of trade. It affects the balance of payment. Current account surplus leads to currency appreciation. So I have a couple things here for you. Well, let's just bring it in. So this is from the Bureau of Economic Analysis. And I want to give you kind of an update with this whole COVID thing. U.S. international transaction for the second quarter 2020. That's the latest I could find. And so it shows us that it shows us that the current account deficit has widened by 52%. That's half, right? And so what do we have here? When you look at the quarterly current account and component account, and by the way, if you are following along with your book, page 107 has the simplified balance of payment, kind of a little sheet there that shows you what I'm showing you currently now. And so, you can see how things are changing, right? In terms of service, primary goods, current account, secondary income, everything is, of course, dropping, right? And so that's the impact of COVID. But look at this one. The U.S. current account transaction imports of goods and services and income payments, and exports of goods and services and income payments. So that's been the net effect lately in terms of the BOP for the United States. All right. Again, that's the Bureau of Economic Analysis. So now, moving forward, let's look at the fourth item. So this was, again, productivity and the BOP is what we've done. That was item number 3. And now let's go to the exchange rate policies. So it gets really interesting now because there's 2 exchange rate policies. And these bears are going to help us remember what they are. Note, one's floating, one is fixed. So that's what we're going to do. We're going to look at the floating exchange rate policy and we're looking at the fixed rate policy. Thank you, bears. The floating exchange policy, the willingness of a government to let demand and supply condition determine exchange rates. So you have what's called a clean float. Basically, think of it as a laissez-faire, right? Just let it be in French. It's your Econ 101 term there from Adam Smith about let the market dictate. Just everything done by supply and demand, everything meeting at equilibrium point, and there's no government involvement whatsoever. Well, that's fiction because most countries don't have a clean float. Dirty float is you're using selective government intervention to determine exchange rate, and that's what most countries use. No country is going to just leave its entire economic well-being to just the laws of supply and demand. The government is going to be involved. And so there's a target exchange rate, they're called crawling bands, that specify upper and lower bounds within which an exchange rate is allowed to fluctuate. Without trying to get too technical, I thought I'd share this with you. It's really cool, very interesting, right? And so what we have here is we're looking at Costa Rica, and we're looking at over the years how Costa Rica handled its currency and tried to curb inflation, right? And so if you look at the terms we're using over here, right? First, look at the inflation rate right there, around 81 through 84, ridiculous. I mean, insane, right? The mean inflation at 27%. And so what the country did is starting to use a crawling peg. And using the crawling peg was able to drop inflation to 13.4. And then after that, using a crawling band, brought it down again to 5.5. Now we have a managed float at 0.6%. I don't have the latest, but this is what I have for that. Anyway, it gives you a little bit over here as to how that worked, without, again, trying to get too technical into the terms of crawling band and the peg. So crawling peg, this is more of a day-to-day interaction, and this is kind of looking into the future a little bit with the crawling band. All right, let's see. There we go, the target exchange rate, upper and lower bound within which an exchange rate is allowed to fluctuate. That's how you do that. The fixed rate policy is setting an exchange rate of a currency relative to other currencies. Again, most countries use a dirty float. Some countries that want to try to control their currency from running away with inflation or hyperinflation they peg, and usually, obviously, they peg to the dollar. So pegging is how you do that. You set an exchange rate of domestic currency in terms of another currency. It stabilizes import and export prices and restrains domestic inflation when pegged to a country with relatively low inflation. So this is supposed to work out fantastic. The book written a while back by Thomas Friedman, The Lexus and the Olive Tree, a great way to understand globalization. If there ever was a book, one of the first books on trying to grasp that and appreciating that is one of the good recommendations out there. One of the things that I added to the slides here was from the intro of the book. I think it was The World is 10 Years Old, where the author is in Thailand right around 97 and explains how Thailand pegged the Thai baht to the dollar, thinking it would help in terms of keeping its inflation low. The problem is that the government ended up really having enormous amount of debt, and the government was not able to make sure that it could maintain the pegging of the baht to the dollar. And so when the Thai government failed to honor the peg due to speculation, it created a massive domino effect that actually led to the first global economic crisis of 97. Yes, it all started in Thailand, and then transferred over to Southeast Asia, and then Russia through oil, of course, and then Europe, and then back to the US. So it's a fascinating read, and I recommend it. All right, so that's the fixed rate policy, right? So that's our fifth. And now going to our sixth cause in determining foreign exchange rates. Let's look at psychology. So investor psychology. You are looking at, predicting short-run movement of exchange rates. There's something called the bandwagon effect, right? There are different terms for that. I've even heard the digital herd, since all trading is done online. It affects the effect of investors moving in the same direction at the same time, like a herd. In fact, going back to the previous slide with the Lexus and the olive tree, that is another topic that was discussed about how this bandwagon effect led to what led to this massive chaos in Thailand. Capital flight, phenomenon in which a large number of individuals and companies exchange domestic currencies for a foreign currency. Well, that's very much happened in Argentina in all of its crises, where the currency, the dollars even left the country. People repatriated their funds, and I'll talk more about that when we talk about the IMF. All right, so we're done with that, and now we're kick into gear with history of the international monetary system, the eras, right? So this is a little bit of history. We're going to keep it straightforward there. The gold standard, the Bretton Woods system, didn't last very long. Post-Bretton Woods system. And so the gold standard had a pretty good run, 1870, 1914. For those of you who remember your history, maybe you can think of what's special. 1914. 1914 is the first year of World War I, right? So the gold standard value of major currencies was maintained by fixing their price in terms of gold. Sounds easy enough. It's a global peg system. It was less volatile. It was highly predictable and stable. Done. But as World War I starts, combatant countries printed excessive amount of currencies, and countries engaged in competitive devaluation to boost exports at the expense of other trade partners. So that just killed the gold standard. What happened is, look at the next years there, the Bretton Woods system, right? And so from 44 to 73. So if you look at 44 is an interesting year because it's 1 year prior to the end of World War II. 1945 is when World War II ends. So remember, this is when the Allies are meeting. There we go. That's Bretton Woods, New Hampshire. This is where they met to draw it out. And they came up with the agreement, the Bretton Woods Agreement, that actually created several things. We'll talk more later on, but the International Monetary Fund, the World Bank, both are the creations of also the Bretton Woods systems, or Bretton Woods Agreement. So what came out here is let's just dump let's dump gold, but let's keep the dollar now the de facto currency. And so all currencies were pegged at a fixed rate to the US dollar. And only the dollar was convertible to gold at $35 an ounce. And that way, think of it almost as the US was the intermediary for the gold standard, right? And so there we go. We solved it. We're doing great. We're so smart. It reflected the higher US productivity level of the United States. That's why the US was chosen. But at the end of World War II, again, 1945 is when the World War II ends, U.S. contribution to world GDP was 70%. But rising productivity in the world, and U.S. inflationary policies led to its demise. And so right around 73, think Vietnam War, funding the war, the whole thing, and that's how you start to end up with inflation. So what do we have next? Well, we're getting into our third option, 1973, the post-Bretton Woods system till today. Combination of rising productivity elsewhere and U.S. inflationary practice ended the Bretton Woods agreement, or systems, I should say. The system of flexible exchange rate regimes is what ensues. You have floating and fixed systems, as we just discussed. There's no official common denominator. This is characterized by diversity of exchange rate. So think of it as a pretty natural supply and demand of currency strength, right? As we said earlier, the euro was gaining strength against the dollar as de facto trading currency year to year. But now with COVID, all of a sudden people are thinking like, I don't know what's going to happen in Europe, but more faith maybe in the dollar. And so the dollar is gaining again against the euro in terms of trade. The renminbi, on the other hand, is dropping. I'll show you that in a second. Drawbacks are turbulence and uncertainty. There you go. It's harder to control because, of course, the only thing we know for sure is that change is imminent. All right, now we're getting into some of the outcome of the Bretton Woods Agreement, as I said, and these are the two supranational organizations, the International Monetary Fund, the IMF, and the World Bank. So let's start with the IMF. The IMF is an international organization that was established to promote international monetary cooperation, exchange stability, and orderly exchange arrangement. Think of the IMF as a very important tool to keep the world going. That's really kind of the purpose. And to keep the world going, really economically speaking. So if there's a drought somewhere, if there's famine somewhere, that's not the IMF. The IMF is not the tool for that. That's going to be the World Bank. But the IMF is going to be the one that's going to try to bail out countries that are in trouble financially by lending to them and trying to make sure that they get out of the economic slumps they're in. The core responsibility of the IMF is lending. And so what I have a highlight for you here of Argentina. This is from the IMF. So first, if you look at a little bit of history, IMF at Argentina, this is not new, right? Since 1958, there's been a history of lending with Argentina, and then back at it again. So this is the profile of Argentina from the IMF right there, kind of giving you a little bit of what's going on at a glance, right? 2020 projected GDP of Argentina is -10. Of course, it's not the only country that's suffering right now because of COVID, but it was going into this pandemic with already issues. It's been a member since '56. Outstanding purchase and loan drawing rights, special drawing rights here of $32 million as of March 31st, 2020, and more, by the way, on the way. And so it's scary for Argentina because what you're seeing here is an inflation rate of 53% on the average consumer price. And then what you have over here is the real GDP growth here as a negative 5.7. I don't know what's going on with the prediction of the growth going up. That's optimistic. Maybe that's if, the IMF, including the IMF bailout. So anyway, that's for that. The IMF collects funds from member countries. That's how they get the money to lend to other countries. Member countries are assigned a quota, and the quota determines the amount of financial contribution, the capacity to borrow, and voting power. The IMF is, in some circles, controversial. Why? Well, because there's an assumption, and the assumption is that the way of the IMF is the best way. And what does that mean? It means that, yes, I will lend to you, but we're going to follow Econ 101, Capitalism 101, and this is what you're going to have to do. You're going to have to make cuts to your government, very, very unpopular. You're going to also have to collect more taxes from your people. because maybe that's the problem in the first place. Maybe you're not doing a good job at collecting taxes. So just think about any sitting leader in a country that's getting bailed out of the IMF, by the IMF, as a very, very unpopular leader, because the medicine that is required is not tasty at all. It's horrible medicine. Think about it. Maybe you got into power with whatever, if you're right, left, center, it doesn't matter at this point, because by listening to the IMF, here's what you have to do. Cut tons of government jobs. Number one. Number two, taxes. You're going to go either raise taxes or you're going to have to actually collect them. Maybe that's your problem. So whoever's in that position is not going to be very popular. So there's been issues. I'm definitely oversimplifying. It's way more interesting and complicated than I want to make it. But for the argument of global business chapter on currency, we'll just keep it as simple as we can. All right, now moving along to the strategic responses of financial companies. By the way, we'll do more on World Bank later. The IMF is the central part of lending. As I stated, the World Bank is more there to help in terms of countries that are struggling to feed their people, etc. And again, oversimplifying it. The primary strategic goal is to profit from the foreign exchange market. So that's, by the way, we're going to look at strategic responses of two areas. One is financial companies, one is non-financial. So right now, we're going to focus on financial companies. And so looking at that, by the way, we're on page 111. That's the strategic goal, right, is to profit from the exchange market. And so the foreign exchange market, what is it? Where people, firms, government, and banks buy and sell currencies. It's open 24/7. It's the largest, most active market on the planet. $5.3 trillion of trade per day on average. I mean, that is insane. I mean, think about that amount. That's more than 3 times the amount of the world foreign direct investment inflow in 1 year. Massive. What are the functions? To serve the needs of trade and investment, and to trade in its own commodity. So without getting too deep into the details of it, we're looking at just an overview of the transactions here, right? Your author, by the way, gives you great examples of how the transactions work. For those of you who are interested in digging a little bit deeper, this is on page, again, 111. And so what are the transaction types? All right. The spot transaction, classic single shot exchange of one currency for another. I'm going to buy, for $10 worth of my currency, I'm going to buy your currency. And that's today, right there, spot. The forward transaction, maybe what I'm going to do is buy and sell currency now, today, for future delivery. Because maybe I'm betting that the needle is going to move in a way that's going to be beneficial for me, right? So there's currency hedging, which protects traders and investors from exposure to the fluctuation of the spot rate. Notice that's currency hedging. There's the forward discount, which in this case, the forward rate of one currency relative to another is higher than the spot rate. That's why it's a discount. And of course, the opposite for the premium is that in this case, one rate of currency to the other is lower than the spot rate. That's why it's a premium. The swap is the conversion of one currency to another one at a time, into the other one at a time. So again, at a later time, you'll get that currency. So the agreement is to revert the original currency at a specified time to in the future. So I'm going to buy your, euros today, but the agreement is that you're going to buy my dollars in the future at a predetermined time. I hope you can appreciate that the complexity of this, and also that really nobody knows. Nobody knows what's going to happen. Yes, we can. There's a bazillion algorithms out there, but as we'll see, there are multinational companies that don't even do this. 3M won't even touch it. And so anybody who thinks they're smart enough to figure this out, good luck to them. Banks make money through trading money. They capture the spread, which is the difference between the offer and the bid rate. There's the offer rate, the price at which a bank is willing to sell a currency, the bid rate. the price at which it's willing to buy a currency. So that's it for that. We're going to, just basic definitions on some of that stuff. Now, for the really, I think for the part that's going to be more applicable to our class and to this book, let's look at the strategic responses of non-financial companies, right? So those M&Es, multinational enterprises, corporations, even the mid-size, small size, So companies cope with currency risk how? By invoicing in their own currency. For us here in the US, that's great for us. It works. Why? Because of the dollar, right? Like we said, people love the dollar. And so when, we want them to pay in dollar, they might have a reserve because maybe they sold items to the US, got paid in dollar, and now we want them to pay us in dollars. So we can invoice in US dollars, anywhere we want. And currency hedging is, as we, in this case, remember that we talked about that in the previous, but there's now strategic hedging, which is not the same as currency hedging. You spread out activities across different currency zones to offset currency losses in one region through the gains of another. This is where it gets a little bit more interesting, more of a domino effect, right? So if you have these different regions where you do have a presence, and when you see currencies appreciating in one end and depreciating in another end, then this is where you're going to have to make your move. The most basic ways is to invoice customers in your own currency. So I have this here for you. This is current. This is it's current this year. It's not current as of now, October 2020. This came out January 2020 for the year 2019. But this is a big deal. This is big news. What it shows you is from 2017 to 2019, the Chinese renminbi, the yuan, dropped, right, from 5 to 6. That's a really big deal. That as a currency being traded, it dropped. So this is from this site here, Profit and Loss, and it's using data from SWIFT. SWIFT is what's used to trade data. Not trade, but to even transfer data. Thank you. Transfer data from place to place. And so December 2019, the renminbi dropped one position to 6th, right, with a share of 1.9, so less than 2% of world share in terms of trade. The US dollar remains the number one at 42% of global payments, right? That's a 6% increase of the dollar. And so that's what this is showing us, right? Again, if you want to kind of look closer, you could see number one, 40% there for the dollar, kicking into 42%. The euro was at 35.6 going to 31. So there's been a drop there in the euro, and some of that drop has gone to the dollar. The British pound is also dropped from 7 to 6.9, so slight drop there. The Japanese yen it's gained. That's one of the gains, 2.9 for the yen to 3.46. And in this particular case, the Canadian dollar went from 1.57 to basically 2. So you could see the direction of the top currencies, right? And I'll have more on that in a little bit. All right, so let's now go into implication for actions. Fostering foreign exchange literacy is a must. Risk analysis of any country must include an analysis of its currency risk. By the way, I really enjoy the closing case of your author. There's a great case here about Bellini do Brasil, their foreign exchange challenge that I plan on having as an assignment for you, modified assignment. So a currency risk management strategy is necessary via invoicing one's own currency or currency hedging or strategic hedging. Strategic hedging may be unrealistic for smaller, inexperienced firms, and many larger international experienced firms such as 3M don't engage in currency hedging because of its unpredictability. Now, I told you I would highlight the closing case a little bit, so let's do that. Brazil. Brazil, really, really fascinating place. Let's look at what's been going on with Brazil. And by the way, this is just only focusing on the currency, not getting into all the drama that's happened with corruption and how many leaders of Brazil have been jailed. I think 3 now. So first, the way that the case study is broken down is the first part's to look at Brazil's foreign exchange policy. And so for this assignment, make sure that you read that very carefully. You might have to read it a few times. And then, compare that policy to the U.S. policy, by the way. Let's see what else. Parity is going to be a big deal for us to kind of look at parity in terms of currency and what that's going to mean. Then the custo Brasil, which is the cost of doing business in Brazil. Hopefully you remember from the previous chapter, transaction cost, right? If you want to do business in Brazil and you're an American M&E, just remember that you can, try to even calculate in advance what that's going to mean to you in regards to your transaction cost. And then lastly, for the case study, strategically balancing exporting and importing. Now there's a chart on page 118 from your author showing you the real to the dollar. Obviously, the book is a few years old now, so the chart ends in 2017, which is why I wanted to kind of update you. Just how insane things have gotten since the production of this book. And so if you follow along with the book, again, for those of you who have it in front of you, page 118, and you look at the chart ending in 2017, the real was around just above $3, right? It was trading at $3. And the idea is that the highest point for the real was when Brazil lost its investment grade. I haven't talked too much about that. I think your author mentions it in here, but we haven't really discussed that. But basically, the same way that you have your own credit rating, you want at least 800, 700. That's really good credit. The higher your credit, the better. The lower, the worse. Countries also have credit rating, right? So Moody's is the very famous credit rating agency. And if a country is starting to lose confidence and loses its rating, then of course it costs more money to invest there, and there's a flight of capital. People leave. And so the highest point of the real was $4.10 per real, and that was in 2015 when Brazil lost its investment grade and there was a flight of capital. So 2015. What I did here for you is I wanted to kind of show you, again, using the covers of the Economist magazine. As you can see, when the currency starts to depreciate, it's, everybody's like, wow, look at Brazil's taking off, and this is, you're looking at, less than $2, right there. And then now what do we have? Has Brazil blown it? You see a pattern, you see a trend now where that currency is going up again. Brazil's fall is right here. This is Dilma Rousseff with the corruption scandal being jailed. But fast forward to today. Look at that. That's $5. This is a record high. This is the highest ever in the history of Brazil. And it is alarming. This is what I have for you here from Bloomberg. Brazilian real plunges to record low against the dollar. Officially now in the world, there we go, it is the worst currency, worst in the world performance, I should say. And unfortunately for Brazil, has reached a new peak, right? And so it's ugly, and that's why I thought I wanted to highlight this case, bring it up to speed as well. It'll be part of your assignment. Another thing that I'll have you do is listen to a podcast. It's an old podcast, but it's really cool. It's from NPR. It's Planet Money. It's called How Fake Money Saved Brazil. There's the hyperlink. You can Google it. But it'll kind of also give you a little bit of history. And yes, it's called the real or real for a reason. Well, try to do this in less than an hour. It looks like I did it today. So again, moving into the quiz on Friday, just get your definitions out of the way. We talked about everything here. As always, make sure you know, flashcards have always worked really well for me in college. Do what works best for you. There's the summary to make sure you wrap your head around what we've covered. I know there was a lot of material, and I believe that you might have to read things twice because the definitions are important, but of course understanding the concepts, the applications, and applying that, by the way, remember, to your country. Remember that there's a project here tied to this as well, and so make sure that when you look at your assignment for the country project, go to the currency part of the assignment that deals with trade, identifying your top trade partners, etc. And make sure that you do it now. All right. See you guys for the next chapter. Chapter 8 will be Capitalize on Global and Regional Integration. Super exciting chapter. This is about trade integration. This is about, countries getting together, getting rid of walls, getting rid of borders because they've realized they can be stronger together that way, but giving up some sovereignty in the process, which comes at a price. And also we'll discuss this new movement in some countries. Look at Brexit in the UK, where some countries have decided to kind of go back instead of, I guess, what most would say forward with levels of trade integration. See you guys next time.